And then the second thing that I think we can learn from the dot-com bubble is that ignoring investing basics can have consequences. Okay, even as the stock market began its meltdown in 2000, individual investors caught up in the rush to riches continued to dump money into equity funds, and many failed to do their homework and research the stocks that they were buying. Prices didn't always reflect the underlying business performance. Most of the new public companies weren't profitable, but investors ignored poor fundamentals and increasing warnings about overvalued prices. Right? When you get into these bubbles, like we talked about earlier, people get into this euphoric stage where they think things are going to go up forever and things are never going to come down, and there's never going to be a reason for things to come down. And of course, these companies are going to be profitable because the technology is that good, so they have to be profitable, right? Well, not necessarily, right? But if you just look at the technology, if you just look at the potential, and you don't look at what actually is, then you're going to have a lot of issues, because a lot of investors like to look at future growth. And that makes perfect sense, because the only way you can price a stock today is to know what future cash flows it will create tomorrow. But the problem with that is that there is no guarantee on those future cash flows, right? So you have to have a certain level of certainty about those future cash flows. And if there is no level of certainty or basis by which you should be assuming that they will make future cash flows, then you cannot put a value on a stock. There are many ways to analyze a stock that you're interested in, with technical, quantitative, and qualitative analysis, and by asking questions about red flags, right? It can help in determining whether a company is undervalued or overvalued, which is ultimately what we want to know. We want to invest in things that are undervalued and divest from things that are overvalued, okay? Even if you're familiar with what a company does and the products and services it offers, it can help to look deeper. If you don't have the time to do your due diligence to look at price to earnings ratios, business models, industry trends, you may want to work with a professional, or you may want to invest in index funds and not worry about individual stocks. And that will help you out a lot in not having to worry about putting valuations on things like these individual stocks that there may be no basis for them to go up over time. Okay, so that's the second thing. Ignoring investing basics can have consequences. Now, the third thing that we can learn from the dot-com bubble is that momentum is tricky. Right? Momentum trading, when done correctly, can be profitable in a relatively short amount of time, and successful momentum traders can turn out profits on weekly or daily basis, right? But what I teach you on this show and what we are not momentum traders, right? We are long-term investors. We aren't about short-term gains. We are about long-term investing and long-term returns. Tech stocks rallied in the late 1990s because the internet was new and everybody wanted a piece of the next big thing. But when the reality set in that some of these dot-com darlings weren't going to make it and others would take years to turn a profit, the momentum faded, right? Investors who got in late or held on too long out of greed or panic or stubbornness came up empty-handed. Right? And this is the issue with momentum. The issue with momentum is that, yeah, on the upside, it's great, right? And if you can ride the roller coaster up, then that's awesome, right? But when the roller coaster comes back down and you're still holding on, then whose fault was that? As an investor, you're not just judged by the money that you could have made, but you are judged by the money that you actually make as you hold on to investments over a longer period of time. Now, identifying a potential bubble is tough enough, and it's only the first step in avoiding the fallout should it eventually burst. Determining when that will happen can be far more challenging. If day trading strategies and short-term investing are your thing, you may want to pay attention to the trends in your own gut and get out when they tell you it's time. But this is not what we want to do, right? We don't want to be short-term traders. We don't want to listen to our gut, right? We don't want to look at trends, right? We want to understand long-term value and how companies are going to grow over time and how markets are going to change over time and how we can make the best outsized returns over a long period of time, a 5, 10, 15, 20, 25 year time horizon, not just over the next week or month, okay? So momentum is tricky.